So this is one of the easier graphs. There aren't too many scenarios that we have with the money market. So we have demand for money, and this is basically so how much of your wealth do you want to hold in the form of money as opposed to holding some other assets. So this is really based on the opportunity cost of holding money. So if I'm holding cash, think of it as cash, but it could also be demand deposits. So if you think about the nominal return, the interest rate on cash is going to be zero. And so you're really comparing it to some interest rate. This nominal interest rate is really the interest rate on money substitutes. So we're thinking of like short-term interest rates, holding some asset that can earn interest that is at least a somewhat close substitute to money. Because there's lots of assets you can hold, but we don't really want to compare holding money to owning a house or something. So we're talking about money substitutes that are able to earn some interest rate. So if that interest rate is higher than other things being equal, I don't want to hold as much money because I could be holding some asset that's earning that interest rate. So there's a higher opportunity cost of holding money, and my quantity demand for money is going to be lower, other things being equal. And if that interest rate is really low, well, there is a convenience factor for holding money. So other things being equal, if I'm not giving up much interest, I might as well, keep more money available to make purchasing decisions and so on. So that's all the demand for money is. Now we're using the nominal rate here. You can think of this as, again, trading off money, which we're going to assume does not earn any nominal interest. So if you think about the nominal return on cash or a demand deposit that doesn't earn interest to be zero, you're just comparing that to the interest in nominal terms that I could be earning on that asset. So the difference is the nominal rate. And you could also think of it in real terms. So what's the real return on holding money? Well, if it's a zero nominal rate and there's inflation, then the real return is really negative the inflation rate. So pi being inflation here. So you're losing that return if you're just holding cash and there's inflation, versus I could be holding some asset that earns a real interest rate. So if I'm adjusting it for inflation because I'm thinking in real terms, then I'm looking at the difference between these two interest rates, and it's still R plus inflation, real interest rate plus inflation, which is the nominal interest rate. So whether you want to think of it in nominal or real returns, it's still a difference between the nominal rate and zero, or that's the same difference. So it's still, that's why we're comparing it the nominal rate versus the real rate. Okay, so we've already learned about the Fed and the money supply, and so in this market, the supply of money is just determined by the Fed. So remember, ultimately the Fed can get whatever money supply it wants. If it sees that the banking system is creating less money than it would prefer, just keep injecting reserves into the system and increase the money supply. So it's not dependent on the interest rate, it's dependent on what the Fed wants it to be. So it could always use open market operations to reduce or increase the money supply. So if it wants it to be Q1, it's going to ultimately be able to get Q1. Even though it doesn't directly control what banks are doing in terms of lending, it could always just inject more money or take money out of the market and just get whatever supply it wants. So basically, the only thing that's shifting the supply curve here is actions of the Fed. So if the Fed wants to stimulate, it wants to do an open market purchase, inject reserves, buy bonds, increase money supply, shift that supply curve, and we can see that's going to cause that interest rate to go down. So we could think of this as like the Fed funds rate. So the Fed wants that Fed funds rate to go down, and so a lot of short-term interest rates are going to tend to move together. So if short-term rates are falling, the Fed can kind of cause that Fed funds rate to fall. Is going to cause other short-term rates to fall. So whether we're looking at the Fed funds rate or some other short-term asset, we're going to assume these rates tend to move together. So when the Fed expands, it's going to be pushing down that short-term nominal interest rate, and that's going to be expansionary, right? Lower interest rate, more investment, consumption, so on. So increased money supply, lower interest rate. What can cause demand shift for money? So again, any graph that we're looking at, if we're just talking about a change in that rate, we're moving along the curve. If we're talking about wanting to increase your demand for money for some other reason, then it's a demand shift. So a couple major shifters are going to be price level. So other things being equal, if things are costing more, I need to make purchases. Well, I need to hold more of my wealth in the form of money in order to make purchases. So higher price level, other things being equal, increased demand for money. Other major one is going to be higher GDP. In other words, higher income, higher national income. So think of that in terms of people are just making more transactions, they're buying more stuff, and so when you do that, you need to hold more money. That's also increased demand for money. Could be other things such as less need to hold money because of changes in banking, availability of ATMs, things like that, credit card usage, something like that. So that could also affect demand for money. Might be a decrease in demand and would just be going this way. Now think about what's going on here when there's an increase in demand for money. So basically, people are trying to hold more money in the aggregate, and there's only this much money out there. So remember, the Fed is controlling this quantity of money here. And so if everyone's trying to hold more money, well, there's not enough money for everyone to hold at the previous interest rate. So what's going to happen is that as people try to increase their money holdings, they are selling off other assets. Now, when you sell interest-bearing assets, you tend to drive up the interest rate. So people are getting out of those other assets. So as you drive up the interest rate, this is going to reach equilibrium. So that interest rate has to adjust in order for people to want to hold exactly the amount of money that is actually there. So that demand for money drives up the interest rate until people are willing to hold that same amount of money until the Fed makes a change here. Now, other things being equal, this is going to be contractionary. So if nothing else changed, higher interest rate, then that affects investment consumption. That's going to be contractionary. Now, one of the things that makes macro tricky is that things are not usually held equal. So if this is a result of, we just talked about demand shift as a result of GDP, well, you could have, a booming economy causing that demand increase for money. And so it wouldn't really make sense to say, therefore, that's contractionary, because it might be the result of a booming economy. So that's why if we're holding other things equal, then we want to say this higher interest rate is contractionary. So people are just all of a sudden demanding more money for some other reason, then that could have this contractionary effect. But we can say that compared to the case where the interest rate didn't rise, even if, so let's say there's a booming economy that causes demand for money to go up, well, compared to the case of the interest rate staying the same, if the interest rate does in fact rise, which it would here, then that would be more contractionary compared to the case of the interest rate being over here. So the higher interest rate, again, other things being equal, regardless of why this demand increased, other things being equal, it is more contractionary than if the interest rate had stayed at the previous level. Now, one other interesting thing to think about is what happens if demand for money increases and the Fed is targeting that short-term interest rate. Remember, they're targeting the Fed funds rate. So if you think of this as either similar or equal to the Fed funds rate, well, if this is what changed, the Fed, if they haven't changed their target, they need to respond to that, because they're saying, oh, interest rates are higher. Well, we're targeting this interest rate at I1. What do we have to do? We've got to respond to that. So increased supply of money in response to that increased demand for money in order to keep interest rates the same. Because remember, if we held other things being equal, this would be a contractionary change. Well, the Fed doesn't want this to be a contractionary. It's targeting this particular interest rate. It's going to say, okay, you want to hold more money, here's more money. So we're going to prevent that from having this contractionary effect by offsetting that demand for money and increasing the supply of money.